Hi everyone, Bob Thompson here again for the first quarter update of 2026. And as usual, we have Martin Danielak here with us. So never disappoints. Lots of interesting things happened in the first quarter here, from wars to oil prices to everything else. So I think we should dive right into it, Martin, and see what we can say about markets.
Yeah, it was definitely an updated, a very eventful quarter, sorry. We were really happy with how our portfolios performed. At the start of the year, we spoke about how we were going to proactively plan for 2026. We said that we expected volatility, and our call for the year was energy to be one of the strongest asset classes. But it's funny because our call was based upon supply and demand, and it wasn't focused at all on geopolitics.
Right. You know, sometimes you make a good call, sometimes you get a little bit lucky in timing, and sometimes both happen. So, I think if you go to where the value is, you're always going to do fine. And we looked late last year and saw there was a lot of value in the energy sector. Oil prices were down. We look at technicals. The technicals were showing that maybe things were oversold, and there was a bit of a rebound that was going to happen. So when we can put fundamental analysis and look at the charts a little bit, we can come up with a conclusion a lot of times. So we pulled the trigger late last year. Obviously, nobody knew that the Iran war was going to happen, but you got to plan for things before. And if you go to where the value is, then the market comes to you sooner or later. And I think that's what we started to see here is the market, came to us when the war started to happen. So we were positioned. We were pretty happy with the way things progressed throughout the month, but we can talk about that a little bit later. I think that, there's a lot of tourists as we talk about in these sectors, right? They come in and out, right? But if we can kind of take a long-term approach and see that maybe we're in a bull market for the next few years for some of these commodities, we can simply take a position and, as I said, wait for the market to come to us, and that's what's starting to happen.
Yeah, and that's a really good point that you made in terms of positioning for a few years ahead. And that's what, unfortunately, we speak about it a few times to clients that most people are just positioning for the next month or two, very short-term ideas, very reactive. And in that instance, you just don't have an edge. If you position a few years out based upon what's happening and with a high degree of confidence, you'll know that certain things will happen. Right. Then you're able to have an edge over the market itself. And with oil and gas, we were looking at U.S. shale inventory starting to decline, and that was a fundamental thesis. Geopolitics was an element of it, but you never knew where it was coming from. But one of the most important things we saw was gold let out of the gates, and we spoke about that last quarter. Right. And usually when gold is well outperforming oil, there's some mean reversion that happens, and that's exactly what we saw this first quarter. So, can you touch on what many investors are likely still missing because they believe that oil prices will return with a ceasefire in place today?
Sure. Interesting enough, some of the energy stocks have risen. Well, they all have during this war, and now they've pulled back a little bit. But they're really only trading as if energy is going to be $70 a barrel, going forward, which isn't too high off the lows there in the low 60s, which it was before all of this happened. And I think, I don't think the market is realizing that, this is a structural change. This Iran war obviously has hurt a bunch of infrastructure, right? But this infrastructure is damaged for the next few years, right? These ships that are in place, it's going to take the ships 30 days to get there. 30 days to get back after everything is flowing properly, right? We were in for a pretty tight squeeze. In North America here, I mean, we have energy, right? But we still rely upon world markets. Here in Canada, I think we have a tremendous advantage. The U.S., but obviously I think they're in decline. So a lot of the world here is going to be disrupted by these energy prices, and I think that's going to be a longer term phenomenon. And then what people are going to start to see is when all of this from Iran is fixed, for example, oil prices are still going to be relatively high. And people are going to say, why is that? And that's the reason for that is the reason that we bought energy back in October, November. Once we get over this hump of the war, we still have some structural issues that we have to deal with here, and that's gonna hurt energy. It's gonna hurt liquefied natural gas, because a lot of those terminals have been damaged, and I think that's going to help a lot of the offshoots in the energy sector, such as uranium and the other areas.
Yeah, and it was whether it was tariffs last year or geopolitics this year. What you're seeing are countries reallocating, where they get their sources of energy, or either other critical minerals and metals from, and they're looking more local or at more secure supply chains.
Right.
And at last quarter, we talked about Canadian exceptionalism. And one reason we really like Canadian energy, and you mentioned about this, is, the stability of its production. But what most people don't know is the long life of the assets. We have significant reserves in place that could last upwards to 100 years. Really depends on technology and a lot of other factors. But those two aspects make it one of the most attractive energy jurisdictions for any countries looking at us. Moving on from energy, after the ceasefire was announced, markets bounced back pretty materially. More so in the U.S. that saw most of the decline. Why did this occur, even though energy prices remain elevated, above $90 today?
Right. I think we've had a pretty long bull market in stocks, and people get mentally conditioned, and I think that's why psychology is way more important in investing success than figuring out what's going to happen with the economy. So people are mentally conditioned that, hey, the market drops, we're going to buy, and we buy more. So that happened. The second thing that happened was kind of tactical in the markets. As I mentioned, you have a lot of tourists. You have a lot of people trying to figure out this week what the market's going to do. So what we had is everybody was on one side of the ship at the bottom there. And what I mean by that is a lot of people were negative on the market. And, a real simple way to kind of see how the market's going to bounce is you just look at sentiment. And if everybody's on one side of the ship and everybody's negative, a lot of short positions, etc., and people are positioned that way, then, almost always the market's going to bounce the other way, and it's going to do extremely well. So that was the case kind of at the peak emotionalism. Same last April, right? A year ago exactly, with the tariff tantrum, everybody was on one side of the ship, negative at the bottom, and then the market snapped back very, very quickly. Now that goes the other way too, and everybody's extremely positive on the markets, and they've got rid of all their hedges and their short positions and all these sorts of things. The market usually has some softness after that. So, there's 3 or 4 reasons, but I think, those are the 2 big ones. If we get sustained energy prices, we're going to get some inflation. And I should note that something we're being very conscious about is that pretty much every recession that's ever happened for the last 50 years has been caused by rising energy prices, dramatically rising energy prices. So does that mean we're going to have a recession this time? Well, not necessarily, but there's certainly heightened risks. I think the other thing that the market's looking at is, I think most people kind of agree now and believe that whatever the president says down south, he's going to reverse himself if the market does poorly, right? So he tweeted again this morning that the Dow was at all-time highs again, so he's doing great as president. So that tends to be a common theme. So the market looks at that and says, hey, if the market's going to drop too much, you better not be too negative here. You better cover yourself because he's going to say something that makes the market go up. So that's just kind of the world we live in right now, and that I think is a reason for the heightened volatility.
No, that's perfect. So shifting gears, I want to focus on commodities as a whole, because we spoke about oil, we spoke about oil shocks, and we're going to dive a little bit into how oil impacts other commodities later on. But we really saw it in fertilizer and agricultural commodities already. A few videos ago, we talked about our positioning in Nutrien as fertilizer prices recently hit 3-year highs. The closure impacted a lot more commodities than just oil. So right here, I'm just going to share a chart with us. I'm just going to bring it up right now. And it's just focused on the commodity index. And it goes over the last 10 years. And here we have the commodity index in the top chart here. And you can see it really broke out this year in 2026. And it broke out even before, the Iran war began. Here we have the S&P 500, and you can see that it's bounced back nicely already. But most importantly, and this is one of our favorite charts, they're called relative strength charts, and it plots commodities against the S&P 500. So you can see, when this line is rising, which happened after the pandemic, commodities are well outperforming financial markets or equities, indices or stocks in general. And over the last few years, we saw inflation come back down and commodities underperformed, but we've just recently saw a spike up happen. And when these occur, we can see a multi-year bull run in these commodity indices.
I want to stress that we spend a lot of time talking about commodities right now, and people say, "Oh, that's all they're talking about." But the important thing is, if you get that big picture right, this is a decade-long outperformance that tends to happen. That's why we spend a lot of time to make sure we're getting this big picture right. Once we get it right, then as I said, this is a decade, and all commodities tend to follow, and there's a structural reason why that tends to happen, right? As energy prices tend to go up, then it costs more to get copper out of the ground. It costs more to get nickel and lithium and everything else. It costs more to get oil out of the ground when oil prices go up, right? So it's kind of a self-fulfilling prophecy that commodities tend to do well. You get that inflation through the economy, and when you start to get inflation through the economy, stocks generally don't do that well because the input costs for stocks are commodities, right? So it all makes sense once you kind of understand how it works and how it moves through the economy. And I will say, maybe I'll just switch over to Canada here for a second. That's why we see some really big changes happening here in Canada, right? I think government policies are changing a little bit to make things a bit better for finding commodities, selling commodities. I think that, as money has gone away from Canada the last decade, I think money's going to start to come back into Canada. That's going to help our economy. It's going to help the commodity cycle, and it's going to help everything from Canadian banks to the mining companies and the energy companies. So that is really important, and that's why we spend a lot of time on this because, as I say to people, come back to Canada. It's time to come back to Canada, right? Everybody's been leaving Canada with their money. Time to come back with some capital to make things happen here in Canada. And I think I just want to cover that for a second. Canadians all love to talk about remember the time in history when the Canadian dollar was above the US dollar. It hit $1.07 back in 2011, 2012, right around that time frame. And that was because we were in a commodity cycle, and that was the peak of the commodity cycle. Then it went all the way back down below 70. Right, just like it had the previous kind of trough, and here we are right now, and it's surprising people that the Canadian dollar is doing okay to the U.S. economy. Is it going to go back to par? No, not next week or next month or next year. Maybe in a decade or 4 or 5 or 6 or 7 years, we're going to see that it's coming back closer to par. That's not a projection. That's just saying how things happen in commodity cycles. So I think that's really, really important to understand that, we talk about this because this is a decade-long trade. It also tends to happen when U.S. markets are trading at all-time valuation highs, not necessarily all-time highs, but valuation highs. In other words, the market down there is trading, it's only been this highly valued 1% of the time in the past. So, that lines up. We see commodities lining up. We see the fact that the Canadian dollar bottomed. We see the fact that the U.S. dollar's high compared to most other currencies, and that's on its way down. So we have multiple inputs here that are telling us that, it's time for a commodity cycle. Nothing goes up straight, right? No pain, no gain, as I always say. But if we get 2 steps forward, 1 step back, 2 steps forward, 1 step back, then you're going to get 3 or 4 steps forward, right? And that excites everybody, but then you get 2 steps back. Okay, so we're in a bull market. Things are going up, higher highs, higher lows, and I think that's what's important, and that's going to be what defines the next decade as far as markets are concerned.
And these periods typically have greater volatility. Like you said, there's this 2 steps forward, 1 step back. There are always opportunities to allocate more.
Right.
to commodities, whether you're a newer client who doesn't have exposure or you're an existing client who wants to continue building their exposure. So that brings us to inflation. We've talked about a new regime that we're in, and I want to bring up one more chart here, which is the Bloomberg Commodities Index in red over the last 10 years, and then U.S. inflation, CPI. And you can see that, commodities have really broken out, but inflation's just starting to accelerate. And most central banks, they have to always paint a safer story. And, lately they've always discussed that inflation's transitory. Anything that comes from this oil spike will just be temporary in nature. However, they've said that before and they've been wrong. And what they're really missing, I think, is that, oil is a key input, like you stated, in basically everything that we buy in terms of a good or service. Can you speak about that a little bit more?
Yeah, it's funny. I saw a chart recently or a little video, which I thought was fascinating, and it talked about kind of tar and heavy oil when it goes into the bottom of a chimney, and then it's heated up very, very high temperatures, and these very high temperatures, put out basically asphalt, right? And then as the temperatures are lowered all the way up, you get plastics and you get gas for your car and you get diesel and you get jet fuel and you get all these things all the way up. But also you get fertilizers and you get a lot of inputs into things that you wouldn't normally think. So, whether we like it or not, and I know there's a lot of debate, our energy is a big, big influence into the inputs of almost everything that we have. And when that goes up in price, then we get some sustained inflation in the economy. Now, we've talked a lot about how much debt there is in the world, right? And actually, inflation, the governments will never say it, but inflation is not a bad thing for them getting rid of their debt. I've talked about this before, but I think it's super important to mention, we're kind of in the same debt situation as the end of World War II. And at the end of World War II, inflation ran a lot. They let inflation run and they kept interest rates really low. And when you do that, let's say you're an investor and inflation's 6% and you're getting 2% on your GIC. Well, you're losing 4% a year, right? And that means the debt is being worked off at 4% a year too. So I think we're in for a decade of that, where inflation is going to be relatively high, input costs are going to be high, and we're going to see the governments try to keep managing down interest rates, right? And there's lots of ways they can do that, printing money and the yield curve control, all these sorts of things which are complicated. But the fact is, they're keeping interest rates lower than inflation. If they do that, that's one way to work off the debt. But the problem is that harms people's finances, right? And your $1 million today is only worth $500,000 10 years from now because it's been worked off. So that's why, hard assets, commodities are a good place to be. And that's another reason we're talking about that, because, the price of copper, the price of gold, the price of silver, the price of oil, they will go up with inflation, generally speaking, because they have to.
We've spoken about this before. And right now, I think our thesis is accelerating, and we position for this proactively. Of course, we always want to make some small changes and act opportunistically. And in the first quarter, we added a new global manager that did well in inflationary growth environments. We don't want to be always in one, area that's going to highly correlate the portfolio. So to wrap up this discussion on investments, what's our plan moving forward, and has this plan changed much at all?
Sure. We've talked a lot about commodities, but you brought up a good point there. During times like this, it's not just commodities that do well. What we call value investing does well. And value investing is buying undervalued securities with a high margin of safety. That's the kind of investor I am anyway. I don't like bad surprises. Remember, as I always say, the secret to happiness is low expectations. So if you're buying a stock with low expectations, with a high margin of safety, generally speaking, you don't have a lot of downside there. And I think that's, playing defense is the best way to do well over time. You don't have to hit it out of the park. You just have to play good defense. And, that's what value investing is. So that tends to do well during these high inflationary times too, because value stocks have less debt etc. They depend less on interest rates. Um, the other thing that does well is international, right? Especially when the U.S. market becomes 70% of the world's market, which it probably is now. That every time in the past that's been a peak. In the late 60s, it hit 70% of the world's market, and that was it. Went down from there. Did that in 99, 2000, and here we are. Here we are again. So international investing, and especially emerging markets, right? Countries that like Brazil, countries that actually produce a lot of goods tend to do relatively well. So we're trying to find ways in the portfolio, and one of them was this latest manager that we bought in the portfolio, this value manager, who has investments in Mexico and Brazil and Asia and other parts of the world ex-US. So that's what we're thinking about ex-US, and that includes bringing some money back to Canada. Not a lot of people are talking like this yet, and we like that because that means there's still value there. Commodities, obviously, and value investing. Those are the three things that tend to do pretty well during these market environments. And I think that is really, really important. If you get that right, you don't have to make a lot of changes. And as I always say, let the market come to you. Make these changes. Let the market come to you. And I want to highlight that about March, right? March was a pretty terrible month for markets, generally speaking. Now, I was examining the portfolios almost daily. Why? Not to make changes. We didn't make a lot of changes. The changes should have already been made before that happened. If you start chasing markets, it's gonna end badly for you. So we didn't make a lot of changes, but I was very, very pleased to see that the portfolios did exactly what we wanted them to do. We had some hedges in there. We had some investments that went up nicely in March. When the markets went down, we had energy that went up. Right when the markets went down, when the metals and minerals and markets, generally speaking, did poorly. So we were very pleased to get through March, being a non-event. And I was very happy with that. So, we got to look at the portfolios and think about the next event that could happen and position for that now, and then let the market come to us. And, so we're not making a lot of changes. We kind of make these big changes and then do these little tactical rebalances, but I'm very happy with the way things are looking. Hey everybody, back again just to introduce a little bit on estate planning. Martin and I always talk about markets, and that's great, but something else that's really important is the advanced planning. Right? Where are you now? Where do you have to be? Are you on the right track to get there? That's things you can control, or we always can't control the market. So let's talk about some of the things we can control on the advanced planning side. And that's, wealth protection, protecting your assets when you pass along, as well as wealth transfer. How do I transfer my assets in an appropriate way, whether that be through charitable giving or to the next generation or friends, family, whatever you'd like to do. So I'd like to introduce Samantha Russell. Samantha is a trust officer with Solus Trust, which is affiliated with Raymond James. And also she's a lawyer. So she's an expert on anything from charitable giving to all the facets of wealth transfer. And we've been able to use her a lot with clients to give great solutions. So Samantha, let's talk about a couple things that I think would be important to our clients.
Great, thanks for having me.
Yeah, I think the first thing we wanted to discuss is just about Solus Trust and its relationship with Raymond James, as that's a common question we always get from our clients.
Sure. So Solus Trust is an independent trust company. So we were actually founded in 2005. So we've been around quite a long time. And then we became affiliated with Raymond James in 2023, which is fantastic. So it essentially means that we provide Raymond James clients with executor services, trustee services, and power of attorney services. So just making sure that everything's really taken care of for Raymond James clients when they get to sort of closer to their end of
Mhm.
life and for their family and their descendants after they've passed away.
That's great. And I know we have a bunch of services, and you've given great presentations to our advisors. So I did want to, just to share the element of these services so you could just go over them briefly. So I'll just pull it up right here.
Yeah, well, let's do some high level stuff to, that that clients can say, "Oh, wow, that just tweaked my interest," and obviously clients can send those questions into us, and we can pass them on to you, or bring them in to talk to clients. I think that's the most important thing. This is not a transaction. This is not something you can't make an estate plan in 5 seconds. It takes a decade to do it, right? And things are constantly changing. So I think that's important for people to understand.
Definitely, yeah. So we offer a number of services. So we can act as executor under your will. So that's taking care of all the administrative aspects of you passing away. So making sure that all your taxes are paid and making sure that you're not making distributions prior to all your taxes having been paid. Getting a grant of probate if that's necessary, which is essentially a court order confirming that this is the final will and the executor can make distribution. And then just making sure that your wishes are carried out so that your estate is administered and the distributions are made in the way that you wanted them to be made under the will. Now, agent for executor is a service that I actually really like. So if you've appointed somebody to act as executor, but when the time comes they're grieving or feeling overwhelmed with the process and they don't want to really be doing all the heavy lifting themselves, they can hire Solus to act as their agent. So they're still going to be involved in the process. They'll be making the decisions ultimately, but then Solus will do all of the heavy lifting for them, sort of taking on those day-to-day tasks of administering the estate.
And
Now
that's
we
a
also,
surprise. That's
go
a
ahead.
surprise that clients. I've noticed with some of our clients that you do that, because people get into it and they say, "Gee, I really want to do this. I think it's my duty to do it, but it's just way over my head, and I'm grieving." They're going to get some help. I think that's really important, and a lot of people don't realize that. So thanks for bringing that one up.
Yeah, definitely. I think oftentimes we have people in our lives that we think have the
Mm,
capability or the financial acumen to actually administer the estate, but
Mhm.
we're not thinking about how they're going to be feeling at that time, and everybody
right.
grieves differently.
Yeah.
Yeah. And then we also provide trustee and trustee support. So, trustee services essentially if we would be appointed as trustee of a trust. So it's a very similar role in terms of sort of making sure that taxes are paid and dealing with navigating, making sure that distributions are made to beneficiaries at the right time. Some of these trusts can be very, very long term and ongoing. So we can sit down with beneficiaries, sort of make a budget plan for them, and just make sure that they're getting the support they need while preserving the capital of the trust funds. And we can also be appointed as an attorney under a power of attorney. So this is a document where you're appointing somebody to make financial and legal decisions for you
Mm.
on your behalf. If you're still alive, but you don't have the cognitive ability to do so yourself. We also offer legacy planning and wills bank services. So this is essentially going through sort of document review with you. If you have sort of outdated estate planning documents, looking at those documents, seeing if they need to be tweaked in any way, and if Solus Trust can assist in any capacity moving forward with updating your estate plan. And then we have a service called Simplify, which is really a bill payment and tax paying service. So this is more geared at like young, busy professionals who have a lot on the go and just don't want to be managing that aspect of their life. So I think it's quite a valuable, it's a very cost effective service. It's a nice service offering for us. And then, of course, there's the Raymond James Canada Foundation, which offers their charitable giving funds. I really like speaking about this because it's such a nice way to sort of receive some tax benefits, but also make a meaningful contribution. So functionally, how this works is you make a contribution to a charitable giving fund that you set up and create. This charitable giving fund can either be your family name or it can be contributed anonymously. But those amounts are invested, they grow, and a certain percentage of the income is granted out to different charities annually, which is fantastic. So that amount grows for a period of, 10 years to
Mm.
indefinitely until it winds down to a small enough amount that it doesn't make sense to keep it alive anymore. But you can appoint your children as successor advisors to these types of funds. So then they can be in a position where they're making decisions about which charities they should be granting amounts out to, which is a fantastic way to get your children involved in philanthropic endeavors moving forward in their lives.
And Samantha, a lot of my clients know that I have a charitable giving fund, and it's the Raymond James one that you just talked about there. And I just think it's fantastic. I have a 7-year-old and a 6-year-old, getting them involved and talking about helping out other people. And, as they get older, they can start to make the decisions where the money goes. And you just feel like, it gives you some purpose. One of the books I just read said that one of the reasons you should acquire money is to give your family a better life, but to give you purpose, right? That's one of the
Mhm.
big things. And I think the charitable giving fund helps to do that, because a lot of people clients that we've had over the years, accumulate their funds. they have no problem with their day-to-day living. They know what they want to give to their kids, but they're looking for that sense of purpose, especially after they've retired. And the charitable giving tends to do that, and it gives your beneficiaries a sense of purpose too. So I'm glad you're an expert on that for us too.
Mhm.
So now I just wanted to shift gears, and I wanted to talk about, what are the consequences of failing to plan? And so, a staggering amount of Canadians, about half of Canadians don't have a will in place. And the most common reason is procrastination.
Right.
Creating a will or estate plan has no deadline. It's not like your taxes where you have to do it every year. So people tend to put it off. Also, they don't want to talk about their own potential death or incapacity. Makes them feel mortal in some instances or makes the process a bit uncomfortable.
Mhm.
So I want to talk about that a little bit more and provide some examples, perhaps around, not having a will and what are some dangerous consequences.
For sure, yeah, definitely. And they are hard conversations to have. I do understand wanting to avoid it. There is no deadline, or I guess no deadline that we know about. So we probably just need to get the planning in place as much as we can. Having these conversations is difficult because, yeah, we don't want to think about our own mortality, but also I would say all of us have things in our family that are challenging to talk about. So I think it's important to just get a sense of sort of what could happen after you pass away if you don't have that planning in place. So if you die intestate, as it's referred to, so this is without a will, there's a Wills, Estates and Succession Act in BC, which governs how your assets will be distributed after you pass away. So typically you're looking at a percentage being distributed to your spouse, another percentage being distributed to your children, and they've sort of determined how the pie is going to be split, so to speak. So what will functionally happen is you'll pass away and likely a lot of your assets are going to be liquidated to accommodate for this distribution, regardless of whether it's a good time to liquidate
Mm.
those assets based off the market, regardless of whether there's any penalties for doing so. And so it can have pretty severe consequences. If you're a business owner, that means you've had no say in who's going to be carrying on running the business, no say in sort of how those individuals are going to be able to interact with partners in the business that may, survive you. So it
Mm.
can have pretty severe consequences from that point of view. And if you've got any minor children, this can be like a big, big hurdle. So in BC, if you don't have trust set up under your will for your minor beneficiaries, the public guardian and trustee has to step in and act as trustee of those amounts until the children turn 19. Now, they charge extremely, extremely high fees. You have to go to them and request access to the capital regularly. And then you're going to have the children receive those amounts outright when they turn 19, which is typically not a good idea, no matter how responsible your child is at 19. So it can just be a bit of a challenging situation and something to think about. And I want to clarify also that the public guardian and trustee can get involved even if there's still another parent alive. So if there
Mm.
were assets that just you held solely that weren't in joint names with your spouse, and then you
Mm.
pass away, the public guardian trustee still has to be involved, even though that other parent is around. So I've just worked on some nightmare files that are so
Mm.
complicated for the family, and they just didn't need to be. And typically, this happens where there's sort of a sudden passing in the family. So it can be very, very stressful. I would say another sort of common issue is like, okay, my kids are great right now. They're in healthy, functioning relationships, but what if those relationships break down? So just making sure that you have that added layer of protection. If you leave funds to your children in a trust, there is that sort of additional safeguard in place because any assets that they do receive through an inheritance, any growth in those assets can be subject to division on a marital breakdown. So if those assets are held in a trust, then you've got that added layer of protection. You can just make sure that your wealth isn't going elsewhere if there is a breakdown in the relationship.
You bring up a really good point there because I don't think a lot of people think of that. They think, "Oh, I wouldn't need a trust. What does my kid need to be a trust fund kid for?" But that isn't necessarily always the case, right? It's the protection of assets, and people don't think about that a lot. I think that's really, really important in this day and age for people to think about that. And something I just learned from you right there was the fact that if two spouses have their own individual accounts and one of them passes away, even though the other spouse is there, the public trustee can still get involved. I think that's something that should trigger people in their minds to say, okay, wow, how are things set up? That's good
Mhm.
that you brought that up. Thank you.
No
Yeah, I
problem.
think there's a lot of positive benefits from just engaging in planning. You could look at potentially lower costs, following your wishes as you want them to occur. And you might not even have thought of those, but at least these questions are raised to help you plan for them. But more importantly, your beneficiaries will likely get the assets a lot quicker. And then one element that you always brought up with me is privacy. Can you just touch on that in terms of, what happens with certain assets that are potentially subject to probate and how trust can create privacy where they wouldn't be?
Yeah. So if you have to apply for a grant of probate, which is that sort of court order saying, yes, this is the final will, you can make distributions under this will without being held liable on part of the executor. You have a statement of assets and liabilities, and then that document becomes a matter of public record. So if you've transferred your assets into a trust, let's say an alter ego trust or joint partner trust, which are retirement planning vehicles available to Canadian citizens over 65, you don't have to make that asset disclosure when you're applying for the grant of probate because those assets don't need to go through the probate process. You're just able to make distributions. The trustee is, after those individuals have passed away, to the beneficiaries. So there's that added layer of privacy when you're dealing with a trust like an alter ego trust or a joint partner trust, which can be important to a lot of people.
And there's also family conflicts that can come up as well, and the litigation that could slow things down. So that's very important. The last thing I think I want to talk about was something that you touched on is something that a lot of our clients face, especially within a mining cycle. They're exposed to large stocks or options with great capital gains. Why is it useful for them to engage into estate planning early?
Yeah, so if you anticipate when you pass away that there's going to be a large capital gains tax bill, because as you know, when you pass away, the CRA looks at it as you sold all of your assets at fair market value, which of course you have not, but that's the tax bill that's going to be owing as a result of your passing. So there are lots of mechanisms to minimize or defer that capital gains tax owing so that you don't get hit with that bill right away. So some sort of advanced tax planning, an estate freeze, for example, can be helpful. The creation of a family trust, those types of mechanisms can be put in place, which means you're deferring that capital gains tax liability much further down the line, which can have positive impacts on you and your estate and your beneficiaries. So it's really, really worth looking into that type of planning so that you're not just attracting the most negative tax consequences possible in the situation.
Well, that's it on my end. Is there any closing comments from Bob or Sam?
Well, I was just going to say thanks, Sam. I mean, obviously we've talked about probably one millionth of the information that you have to give, but we just wanted to kind of highlight that you're here, you're available, services are available, and really I think it's important for clients to start to think about that. It is part of our advanced planning, so we do bring it up with clients on a regular basis, and I just wanted to introduce everybody to you, and hopefully we can chat more in the future.
That's fantastic. Well, thank you
Okay.
so much. It's lovely to meet everyone. I hope to chat with a bunch of you very soon.
Thanks, Sam.
Yeah, thanks again, Sam. And I just wanted to let everybody know, please reach out to us if you'd like to book a meeting with Sam or one of our other trust officers to discuss your estate planning needs. Otherwise, we look forward to the next video. We're going to continue to highlight our team strength either through our expert network or even with our employees within our team. And I just want to thank you both again. It was a great meeting. We look forward to the next one.